Every technical indicator tells a story, but successful traders know how to interpret the signals. In this quiz, you'll test your understanding of the MACD indicator and its role in identifying momentum, trend direction, and potential trading opportunities. Using concepts from Lesson 19, you'll analyze real-world scenarios and make informed trading decisions. Let's begin. Question 1. What does the MACD line represent? Is it A, the distance from the zero line, B, the difference between two EMAs, typically 12 and 26 periods, C, a moving average of the signal line, or D, the difference between price and volume? You have 10 seconds to record your answer. If you need more time, just pause the video. The correct answer is B. The MACD line represents the difference between two EMAs, typically the 12 and 26 period. That gap between the two moving averages is what the MACD line is actually measuring. Momentum in motion. If you chose A, the distance from the zero line, that's actually what the MACD line shows you after the calculation, not what it represents. Close, but not quite. C, a moving average of the signal line. That's describing the signal line itself, not the MACD line. Two different components. And D, the difference between price and volume. Volume isn't part of the MACD calculation at all. That one's a trap. If you got B, you're reading the signal. Now you know. Question 2. When the MACD line crosses above the signal line, what does it usually indicate? Is it A, a buy opportunity due to bullish momentum, B, a strong sell signal, C, an increase in volatility, or D, that price will stay flat? Think it through carefully and lock in your answer. The correct answer is A, a buy opportunity due to bullish momentum. When the MACD line crosses above the signal line, it's telling you that upward momentum is building. That's the market saying conditions may be shifting in favor of the bulls. If you chose B, a strong sell signal, it's actually the opposite. When the MACD line crosses below the signal line, that's when you start watching for bearish momentum. Don't flip those two. C, an increase in volatility. Volatility isn't what the crossover is measuring. The MACD is about momentum and trend direction, not how wild the price swings are reacting. And D, that price will stay flat. The crossover is a signal of movement, not stillness. Flat price action would actually show very little separation between the lines. If you got A, you're thinking like a trader. Now you know. Question 3. What does the MACD histogram show? Is it A, the total volume of trades, B, the actual price trend, C, the distance between the MACD line and the signal line, or D, the size of candlesticks? Consider what those bars are telling you about momentum. The correct answer is C. The histogram shows the distance between the MACD line and the signal line. When those bars are growing, momentum is strengthening. When they're shrinking, momentum is fading. That's your early warning system before the lines even cross. If you chose A, total volume of trades, volume is a separate indicator entirely. The histogram has nothing to do with how many shares are changing hands. B, the actual price trend. The MACD is derived from price, but the histogram isn't showing you price itself. It's showing you the relationship between two moving averages. And D, the size of candlesticks. Candlestick size tells you about price range within a single period. That's a different conversation altogether. If you got C, you're not just seeing the bars, you're reading what they mean. Now you know. Question 4. What does it mean when the MACD histogram bars are shrinking? Is it A, a reversal is guaranteed? B, momentum is weakening? C, momentum is accelerating? Or D, a sideways market has begun? Think about what shrinking bars tell you about the strength of the current move. The correct answer is B, momentum is weakening. When those histogram bars start shrinking, the distance between the MACD line and the signal line is closing. The move isn't over necessarily, but it's losing steam. That's your cue to pay attention. If you chose A, a reversal is guaranteed. Nothing in trading is guaranteed. Shrinking bars are a warning sign, not a promise. Always wait for confirmation before making a move. C, momentum is accelerating. That's actually the opposite. Growing bars mean acceleration. Shrinking bars mean the energy behind the move is fading. And D, a sideways market has begun. Shrinking bars don't automatically mean the market is going flat. It simply means the current momentum is slowing down. Where it goes next is a separate question. If you got B, you're reading the histogram the right way. Now you know. Question 5. What does bullish divergence look like on the chart? Is it A, price and the MACD both make higher highs? B, price and the MACD move exactly together? C, price makes lower lows while the MACD makes higher lows? Or D, the MACD makes lower lows while price is flat? Think about what divergence actually means. When two things stop agreeing. The correct answer is C. Price makes lower lows while the MACD makes higher lows. That's the heart of bullish divergence. Price is still falling, but the MACD is quietly disagreeing. It's saying the selling pressure is losing strength, even though the chart doesn't show it yet. That gap between what price is doing and what momentum is doing, that's your signal. If you chose A, price and the MACD both make higher highs, that's not divergence at all. That's confirmation. Both moving in the same direction means they're in agreement, not pulling apart. B, price and the MACD move exactly together. Again, that's alignment, not divergence. Divergence only exists when the two start telling different stories. And D, the MACD makes lower lows while price is flat. That would actually be bearish divergence in the making, not bullish. The direction matters. If you got C, you're seeing what most traders miss. Now you know. Question 6. What should you do if you spot a bullish divergence? Is it A, ignore the divergence because price is falling? B, open a long position immediately? C, prepare to buy but wait for confirmation from price? Or D, open a short position because momentum is low? Think about what a disciplined trader does when they see a signal and what they wait for before they act. The correct answer is C. Prepare to buy, but wait for confirmation from price. Spotting the divergence is only half the job. The MACD is giving you a heads up, not a green light. You still need price to confirm the move before you commit capital. If you chose A, ignore the divergence because price is falling. That's exactly the mistake most traders make. Price falling while momentum rises is the whole point of bullish divergence. Ignoring it means missing the setup entirely. B, open a long position immediately. This is the other extreme. Acting on a signal before confirmation is how traders get caught in false breakouts. Patience is part of the strategy. And D, open a short position because momentum is low. If momentum is actually rising on the MACD while price falls, shorting into that is going against what the indicator is telling you. That's trading blind. Divergence rewards the patient trader. See the signal, wait for confirmation, then act. Now you know. Question 7. What confirms a reliable MACD signal? Is it A, only a crossover? B, a sharp move with no checking of the lines? C, just the histogram shape? Or D, the MACD line direction, a meaningful crossover, and histogram strength? Think about what it takes to trust a signal. One piece of evidence or the full picture? The correct answer is D, the MACD line direction, a meaningful crossover, and histogram strength. No single component tells the whole story. When all three are aligned, that's when the signal carries real weight. That's confluence. And confluence is what separates a guess from a trade. If you chose A, only a crossover. Crossovers happen frequently, and not all of them are meaningful. A crossover without supporting histogram strength or clear line direction can send you into a weak or false move. B, a sharp move with no checking of the lines. Sharp price moves can be emotional, news-driven, or manipulated. Skipping the indicator check is trading on impulse, not analysis. And C, just the histogram shape. The histogram is a powerful piece of the puzzle, but on its own, it's incomplete. You need the full context of what the lines are doing alongside it. The MACD is most powerful when you use all of it together. Direction, crossover, histogram, all three. Now you know. Question 8. If the histogram crosses above the zero line, what does it typically mean? Is it A, the trend is ending? B, the market is oversold? C, volume is increasing? Or D, the MACD line has crossed above the signal line? Think about what the zero line represents and what it means when the histogram crosses it. The correct answer is D. The MACD line has crossed above the signal line. The histogram is simply a visual representation of the gap between those two lines. When that gap goes from negative to positive and crosses the zero line, it means the MACD line has moved above the signal line. The histogram is just showing you that crossover in bar form. If you chose A, the trend is ending. A cross above the zero line is actually the beginning of potential bullish momentum, not the end of a trend. You'd be reading it backwards. B, the market is oversold. Oversold conditions are measured by indicators like the RSI, not the MACD histogram. Different tool, different job. And C, volume is increasing. Volume and the MACD histogram are not connected. The histogram measures the relationship between two moving averages, not how many shares are being traded. When the histogram crosses zero, the lines have crossed. It's that direct. Now you know. Question 9. What does bearish divergence suggest? Is it A, price is falling and the MACD is also falling? B, price is rising but momentum is fading, warning of a possible reversal? C, the signal line is unreliable? Or D, momentum is strengthening? Think about what it means when price and momentum stop telling the same story. The correct answer is B. Price is rising, but momentum is fading, warning of a possible reversal. That's the danger signal. The chart looks fine on the surface. Price is climbing, but the MACD is quietly making lower highs. The engine is losing power even while the car is still moving forward. That disconnect is what bearish divergence is warning you about. If you chose A, price is falling and the MACD is also falling. That's not divergence, that's confirmation. Both moving in the same direction means they're in agreement. Divergence only exists when they start disagreeing. C. The signal line is unreliable. Bearish divergence has nothing to do with the reliability of the signal line. It's about the relationship between price action and momentum. And D. Momentum is strengthening. If momentum were strengthening, the MACD would be making higher highs alongside price. Bearish divergence is the exact opposite of that. When price is rising but momentum is fading, don't get comfortable. The warning is already on the chart. Now you know. Question 10. When should a trader act on a MACD signal? Is it A, as soon as one line moves? B, without checking the trend? C, when the histogram touches zero? Or D, after confirming the crossover, histogram direction, and price action? This is the final question, and it's really asking what kind of trader you are. The correct answer is D, after confirming the crossover, histogram direction, and price action. This is the discipline that separates consistent traders from impulsive ones. The MACD is a powerful tool, but it works best when you let all the pieces line up before you act. If you chose A, as soon as one line moves, one line moving is noise until the rest of the picture confirms it. Reacting too early is one of the fastest ways to get caught in a false signal. B, without checking the trend, trading a MACD signal against the broader trend is working against yourself. Context matters. Always know what the trend is doing before you trust a signal. And C, when the histogram touches zero, that's a moment to watch, not necessarily a moment to act. Touching zero and crossing zero are two different things, and even a confirmed cross needs price action behind it. Patience, confirmation, then action. That's the process. That's the mindset. And that's exactly what Market Mindset University is built on. Now you know. Congratulations. You've completed Day 19, Lesson 4. Throughout this chapter, you explored the MACD indicator, crossovers, histogram analysis, and divergence signals, and how traders use them to read momentum and spot opportunities. Up next, Bollinger Bands, a powerful tool for visualizing price volatility and identifying potential turning points. Keep growing, keep learning, and keep building. Now you know.
Ready to master trading psychology? Visit MMU.media and grab your free trading course. See how we teach trading the right way, step by step, with structure and clarity. Practice with purpose. Perform with precision. I'm Michelle, and we'll see you in the next lesson.